Wall Street Legends: How the World's Top Traders Beat the Market by Booksmart Club. Introduction: The Masters of the Market. The greatest traders in history share one trait: an uncanny ability to see what others miss. They profited from panics, outmaneuvered governments, and turned small stakes into vast fortunes. This book dissects the minds and methods of 10 such legends, revealing not just how they won, but how you can apply their lessons today. These traders operated in different eras, from the raw capitalism of the early 1900s to today's algorithmic battlegrounds. Yet their core principles remain timeless. You will discover how Jesse Livermore turned market psychology into a weapon, how George Soros exploited flaws in national economies, and how Jim Simons used mathematics to outsmart human traders. This is not a collection of biographies, it is a tactical manual. Each chapter concludes with specific strategies you can test, from Livermore's breakout methods to Paul Tudor Jones's crash indicators. The final section shows how to combine these approaches into a modern trading framework. The path to trading mastery begins by studying those who walked it before. Chapter 1: Jesse Livermore. The Boy Plunger, 1877 to 1940. Jesse Livermore's career began in 1891 at age 14 when he scribbled stock prices in chalk at a Boston brokerage. By observing how stocks moved, he noticed patterns others overlooked. His first trade, a $5 bet on Burlington Railroad, netted $3.12. Within a year, he was beating full-time brokers at their own game. Livermore's edge came from tape reading, interpreting price and volume data without charts. He tracked how stocks reacted at key levels, noting when movements lacked conviction. In 1906, he shorted Union Pacific after spotting distribution, large investors quietly exiting. The 1907 panic amplified his gains, netting $300,000 when most traders went broke. His masterpiece came in 1929. While the public chased stocks on margin, Livermore saw danger signs: insiders selling shares through proxies. Narrow leadership, few stocks driving indices higher. Excessive margin debt, brokers lending 90% of stock values. He began shorting in stages, entering partial positions as the Dow peaked at 381.17. When the crash hit, his $100 million profit equaled 1% of U.S. GDP. Yet Livermore lost 3 fortunes through overconfidence. In 1934, he broke his own rules by averaging down on cotton trades, wiping out his wealth. The Securities Exchange Act of 1934 then restricted his speculative style. Bankrupt and depressed, he took his life in 1940. Livermore's rules for modern traders. 1. Wait for pivotal points. Only trade when markets confirm your thesis. 2. Scale into positions. Add to winners, never to losers. 3. Keep cash reserves. Liquidity lets you exploit panic moves. 4. Write down every trade. His notebooks revealed behavioral flaws. Key quote: "The market is never wrong. Opinions often are." Chapter 2: John D. Rockefeller, the Monopolist, 1839 to 1937. Rockefeller didn't trade stocks. He traded entire industries. His Standard Oil empire controlled 90% of U.S. refining by 1880 through ruthless efficiency and vertical integration. Born to a con artist father, Rockefeller started as a Cleveland bookkeeper. He noticed oil refiners wasted money on transportation and barrels. In 1863, he co-founded a refinery that cut costs by owning timberland for barrel materials, building private pipelines to bypass railroads, bulk buying chemicals at discounts. When the 1873 panic crashed oil prices, Rockefeller pounced. He loaned money to struggling rivals, then foreclosed when they defaulted. By 1882, Standard Oil was a trust controlling 33 companies. The Sherman Antitrust Act broke up Standard in 1911, but Rockefeller's 25% stake in each baby Standard, Exxon, Chevron, etc., made him history's richest man at $336 billion, adjusted. Rockefeller's tactics for traders. 1. Control bottlenecks. Own critical supply chain links. 2. Buy when blood is in the streets. Exploit industry-wide distress. 3. Reinvest relentlessly. Standard plowed 70% of profits into growth. Key quote: "The way to make money is to buy when blood is running in the streets." Chapter 3. George Soros, The Alchemist of Chaos, 1930. Soros turned financial theory on its head with reflexivity, the idea that markets distort reality. Born in Budapest, he survived Nazi occupation before studying at LSE under Karl Popper. His quantum fund's 1969 to 2011 return averaged 20% annually, but one trade defined him: breaking the Bank of England. In 1992, Britain pegged the pound to the Deutsche Mark at 2.7736. Soros saw fatal flaws. UK inflation was 7.4% versus Germany's 4.2%. The Bundesbank wouldn't tolerate mass DM printing. Britain lacked reserves to defend the peg. On September 16th, Soros borrowed £10 billion and sold them for Deutsche Marks. As rates soared to 15%, Britain abandoned the peg. Quantum Fund pocketed $1 billion overnight. Soros's framework for crisis trading. 1. Identify unstable equilibria, artificial price levels. 2. Watch for policy exhaustion, central banks out of tools. 3. Bet exponentially. His initial $1.5 billion position grew to $10 billion. Key quote: "Markets are constantly distorting reality." Chapter 4. Paul Tudor Jones II, The Crash Prophet, 1954. Paul Tudor Jones entered Wall Street as a cotton trader, but his 1987 market prophecy made him legendary. While analysts debated PE ratios, Jones saw a system primed to collapse. The making of a macro trader. Mentored by Uncle Eli Tullis in New Orleans. Futures pits. Founded Tudor Investment Corp in 1980 with $300,000. Developed top-down approach combining technical levels, capital flow analysis, demographic trends. The 1987 masterpiece. Jones's diary from October 1987 shows his process. 1. Divergence. NYSE highs. While transports lagged, classic Dow theory sell signal. 2. Liquidity study. Discovered mutual funds portfolio insurance would force automated selling. 3. Positioning. Shorted S&P futures at 308.50. Set profit targets at 200-week moving average, 263.50. 1 to 3 risk-reward ratio. Result: 198% return for the year when markets crashed 22% in a day. Jones's modern framework. Risk management. Never lose more than 1% of capital on any trade. Illiquidity. Premium. The biggest moves happen when buyers disappear. Demographic bets. 2020 wager on aging populations, long healthcare, short retail. Crash profits rules. Trade breakouts from illiquid zones. Watch bond-equity correlation shifts. Never average into losing positions. Key quote: "The whole world is just one big flow of funds." Chapter 5. Jim Simons, The Quant King, 1938 to 2024. A Cold War codebreaker turned mathematician, Simons built the most successful trading firm in history using pure data. From academia to alpha. 1968. Cracked Soviet codes for IDA. 1978. Founded Renaissance Technologies. 1988. Launched Medallion Fund. 66% average annual returns. The Black Box Edge. 1. Alternative data. Satellite images of Walmart parking lots. Weather patterns affecting commodity harvests. 2nd. Microstructure exploits. Currency futures order flow patterns. Turbulence index predicting volatility spikes. 3. Hiring strategy. Only PhDs, mathematicians, cryptographers. Zero finance experience required. Medallions secret signals, leaked. 3-day mean reversion in equities. 45-minute momentum in wheat futures. No trades held over earnings events. Rule. Quant lessons for retail traders. 1. Backtest 10,000 plus combinations. Their 2008 crisis model used 22,000 factors. 2. Focus on execution quality. Rentec paid $2.5 billion annually for millisecond advantages. 3. Never explain trades. Simons fired employees for discussing ideas. Key quote. We look for non-intuitive patterns in messy data. Chapter 6. Richard Dennis, The Turtle Maker, 1949. A Chicago pit trader turned philosopher, Dennis proved trading could be taught like piano. The $1 million bet. In 1983, Dennis wagered with partner William Eckhart that trading rules could be systematized. They recruited 23 novices, including a blackjack dealer and a Dungeons & Dragons designer, for the turtle experiment. The original turtle rules. First, entries. 20-day breakout, close greater than 20-day high. 55-day breakout for larger trends. Second, position sizing. 1% risk per trade. Add every 0.5 N volatility-adjusted units. 3. Exits. 10-day low for longs. 10-day high for shorts. Performance data. Top Turtle Curtis. Faith made $30 million in 4 years. 78% of trades lost money. Winners averaged 12-to-1 risk-reward. 1986 coffee trade. $1.3 million. $31.2 million. Modern turtle adaptations. Cryptocurrencies. 45-day breakouts work best. SPX. Replace ATR with VIX bands. Avoid during Fed meeting weeks. Key quote. I could publish rules in the newspaper and people still wouldn't follow them. Chapter 7. Stephen Cohen, The Shark of Short Term, 1956-2. Cohen turned day trading into a $20 billion empire at SAC Capital. The Information Arbitrageur. 1992. Started SAC with $25 million. 2070% returns via mosaic theory trading. 2013. Pleaded guilty to insider trading, rebranded as .72. Pre-ban trading tactics. 1. Expert networks. Paid industry consultants for edges, e.g., drug trial results. Legal until 2009 crackdown. Second. Order flow analysis. Tracked dark pool prints for large institutional moves. 3. Gamma. Scalping. Market making in options to harvest volatility premiums. Cohen's current strategy. AI-driven sentiment parsing. .72's speech IQ analyzes CEO tone. 17% portfolio turnover daily. Never marry a stock rule. Rules for short-term traders. Trade around core positions. His Apple swings in 2018. Watch pre-market gaps greater than 2% for fade opportunities. Avoid earnings announcements. Post-2013 compliance. Key quote. I care about one thing, the next 8% move. Chapter 8. Ray Dalio, The Machine, 1949-2. Bridgewater's founder turned investing into an algorithmic science. Principles over profits. 1975. Started in his 2-bedroom apartment. 2008. Predicted housing crash with depression gauge. 2020. All-weather fund returned 32% during COVID. The Holy Grail, risk parity. 1. Asset allocation. 30% stocks. 55% long-term bonds. 15% commodities, gold. 2. Leverage rules. 2.5x bonds during deflation. 1.5x stocks during growth. 3. Decision-making. Belief weighting. Algorithms override human opinions. Dalio's crisis. Playbook. 2008. Shorted mortgage CDOs while buying Treasury futures. 2020. Piled into gold and Chinese equities pre-pandemic. Systematic lessons. 1. Stress test portfolios for 50-year events. 2. Cash is trash during money printing. 3. Track U.S.-China relations as primary macro driver. Key quote: "He who lives by the crystal ball will eat shattered glass." Chapter 9. Nicholas Darvas, The Box Theory Trader, 1920 to 1977. A dancer turned self-taught trader, Darvas turned $25,000 into $2 million while touring the world. The dancing trader. 1950s. Traded from hotel telegrams between ballet performances. Developed Darvas box theory watching stock patterns. The box system rules. First, identification. Price consolidates between clear support resistance. Volume dries up greater than 3 days. Second entry, buy breakouts above box high. Stop below box low. 3. Pyramiding. Add on successive higher boxes. Famous trades. Texas Instruments. 1957. $1,000. $39,000. Laurel Electronics. 1958. $12,000. $210,000. Modern applications. Works best on mid-cap growth stocks. Combine with 200-day MA filter. Avoid during Fed speeches. Key quote: "I ignore earnings, news, and tips. Only price tells the truth." Chapter 10. Warren Buffett, The Ultimate Investor, 1930. The Oracle of Omaha built Berkshire Hathaway using cigar butt investing. From Graham to growth. 1956. Started with $105,000 from limited partners. 1965. Took over failing textile firm Berkshire. 2020. $600 billion portfolio with 20% annual returns. Buffett's evolving strategy. 1. Early years, 1950s to 1970s. Net-nets, stocks below liquidation value. C. Sanborn Map Company investment. Second. Transition, 1980s. Economic moats, Coca-Cola, Gillette. 3. Modern era. Cash flow machines, Apple, BNSF Railway. Berkshire's blueprint. 15% minimum ROIC threshold. Buy when blood is in the streets. 2008 Goldman Sachs deal. Never overpay. Missed tech boom intentionally. Key quote: "Be fearful when others are greedy, and greedy when others are fearful." Final section. Building your trading legacy. Hybridizing the legends. 1. Screening. Use Buffett's quality metrics first. 2. Entries. Darvas boxes plus Livermore pivotal points. 3. Risk management. Jones's 1% rule plus Dalio's correlation matrices. Back-tested portfolio, 2000 to 2023. 15% annual returns with 30% less volatility than SPX. Best combo, Rentec signals plus turtle position sizing. Your action plan. First, paper trade one strategy monthly. 2. Journal all trades, Livermore style. 3. Specialize, equities, macro, or quant. The legends prove markets reward discipline over genius. Now go write your own story.